Welcome back. Markets holding mildly in the green, and ITC is the stock actually that's perking up. It's at a crucial juncture. We had mentioned there's a bit of a buzz with regard to lower inventory as well as higher prices. For the time being, at least, the street is bidding that up. A big underperformer, not moved much. Interesting to see what comes about. On that note, let's welcome Jigar Mistry, co-founder Point Capital, who joins us on the show. Jigar, first of all, congratulations. I think you were quite bullish on Vedanta. That was one of the metal stocks that you had in your portfolio. It was a bit of a counter trade. Is that correct?
Right, Nigel. Commodities, we have been positive. Largely, we think, this is a play on how the US dollar will react. And any commodity, be it, commodities or bullion, when denominated in a fiat currency, would tend to inflate over the next few years. So given that we're positive on all commodities, Vedanta was one stock that we have held for a while now.
Jigar, sorry to press that point a little bit more, but if you had to talk about one commodity that you'll be more bullish on, I was looking at the Asian steel spreads. They're at the lowest that we've seen in multiple years. Copper prices are doing very, very well. Aluminium seems to be bracing for better times. Nalco management told us yesterday. Silver as well has done quite well. So if you have to, someone who's mastered that a few 10 years ago or so, when we should speak quite regularly solely on the metal space, what would you be most bullish on getting into 2026?
The combination of things, Nigel. So, one, silver is not just a play on how the precious metal refinery acts, but also on the way how, when denominated in dollars, it would tend to be a lot higher. And the commodity complexes more or less work on the same phenomenon. So, aluminum, copper, all of them actually respond to the same sort of line of things. So, I would say, copper, there isn't really a play. What most companies earn is only TCRC. And to that end, aluminum and silver within the preferences that you gave, Nigel.
Okay, all right. Well, Jigar, hi, welcome to the show. Since we are talking about metals, I'm going to add the word precious before it. Precious metals, gold and silver, they've really taken all of the limelight away from equities this year. What's your sense? Would you be a buyer at these levels, and or is it too expensive?
Right, Ekta. So see, I think, this as a fund, we are mandated to run only equities. So in the equity portfolio that we create, we don't really take positions in metals and in precious metals, so to speak. But the point I was discussing with Nigel does hold here, right? Because what had happened, and maybe if I can take you a little bit back till the time the Bretton Woods Agreement was in place, the balance of power was fairly even, right? You had a USSR bloc, you had a US bloc till at least 1991. And for the first 15 odd years, US did behave. But since 2008, they've printed huge amounts of currency. And there isn't enough alternatives for the rest of the central banks to go around. So the first thing when the printing went through the roof was for central banks to call back all their gold and silver. And eventually those are reacting much more to dollar than their demand supply alone. So yeah, I would sort of have the allocation. Gold is known to move around sort of in steps and then flatten out for a while. So timing, etc., I'm not really an expert, but as an allocation, yes, it's definitely worth large amounts of allocation in one's portfolio.
Got it. Okay, all right. Jigar, what are you making of the, the entire money flow that we're seeing in these banking and financial names? NBFC's case in point, Shriram Finance. Are you all playing that theme?
So Nigel, if you actually talk about money flows, I'll give you a statistic which at least got us alarmed a little bit. So if you take CY25 and year-to-date CY26, FIIs have sold close to $38 billion in stock. Promoters through IPO, OFS, and block and bulk deals have sold around $44 billion worth of stock. And companies through QIP and IPO have raised around $38 billion worth of stock. And there has been a singular buyer in the entire process, either via mutual funds or direct equity, is retail. Right now, one way to think is that a lot of smart money is moving out. The other way to think is that retail may not be done yet, given that only 5.6% of household savings is coming into equities. We have come a long way from 0.7% that number was in 2014, but most developed markets are at a way higher number. So if you pencil in just about 10% coming into equities, and given real estate and gold, silver has already risen up, equities may be a preferred medium, then we're talking about $100 billion plus flow year, right? What we have seen in the last 2 years. So what might happen is that things could remain a little more choppy, but it's in the right direction. Your question, yeah, banking financial has been a preferred theme. Some NBFCs have been a preferred theme. So we really like that because a lot of money has been transferred from governments in the hands of people, and some of that is going to get saved via the mediums we spoke about.
Okay. All right. Well, Jigar, how would you be placed on the defense space going into next year?
There is a lot of work, Ekta, that might happen into it, but we think the stock discounts a lot more than that. Right. So as a theme, in fact, if you look at central plus state plus PSU capex, which was growing at a very strong number since COVID, what we are finding for the last year and a half is that that's moving entirely in the hands of people now. So we analyzed the budgets of the past 16 states that went into elections and found that their social spending bill is higher than their capex bill. And even the government revenues at the central government level are down YOY, which means their capex is going to get hurt as well. A total of almost 6 lakh crores, or about 1.7% of GDP, has moved in the hands of people. And the sectors that drove the market post-COVID until 2024, we don't think those will remain. So our preference for the past 9 to 12 months had moved in favor of consumer discretionary, like two-wheelers, aviation, leisure, cement, to some extent pharmaceuticals, and some of it gets saved, so banking financials as well.
Okay, all right, Jigar. Thanks a lot for joining in. Wishing you a good end of the year and a rocking 2026 as well. And I think over the last couple of years, you and your team have scaled up very, very well, and wish all the best.
Thank you, Nigel. Wishing all of you the same at CNBC too. Thanks.
Okay, all right. Well, a good time then to go across to Nimesh, who's joining us.